Alrighty, next one up here is PayPal. So what's going on in regards to PayPal? Well, net revenues came in at $8.3 billion versus $8 billion in the same quarter last year. So good to see revenues up about, we can call it a little over $300 million year over year. Transaction expense was, almost flat. Like it was up very slightly. I think they did a great job managing that. Transaction and credit losses was up to 434 mil versus 396 mil. Customer support and operations, they actually brought that number down on a year-over-year basis to 451 mil from 465. Here's where there's a trouble line. Sales and marketing. $626 million in sales and marketing. That's a big expense, right? Compared to $466 million in sales and marketing. In my opinion on that is, why did the sales and marketing go up so much? Here's why. They had a whole Will Ferrell commercial. They were running that commercial like crazy in the fourth quarter of the year. You probably saw it on maybe YouTube. You probably saw it on the television. You saw it everywhere, right? And obviously the fourth quarter is also the most expensive time to run ads because it's Christmas time. Everybody's running ads. And we had an election cycle, right, that ran in October and into November. So, the amounts of money you had to pay were pretty outstanding if you're running ads, right? So the moral of the story is, ouch, but one of those things it's for a long-term gain there, right? Technology and development, 773 mil versus 770. That's, they roughly kept that in line on a year-over-year basis. G&A, they did bring that up about $40 million year-over-year. Now, here's the deal. If you look at restructuring other, they had a $50 million hit there versus a $311 million benefit at this time last year, which was a one-off help. So if you look at their operating expenses, it looks like, wow, their operating expenses out of control, 6.9 billion versus 6.3 billion, right? But if you take into account that $361 million difference or that delta, it's not as dramatic as it seems, right? So operating income fell to $1.441 billion from $1.728 billion, right? But here's the thing. If you factor in that $361 million difference in those kind of one-offs there, right, you would have been an operating income of $1.812 billion, which would have been, a little less than $100 million of operating income growth on a year-over-year basis. So the moral of the story is here, this would have been a B grade income statement if it wasn't for kind of this one-off difference in restructuring and other. If it wasn't for that, we would have been talking about probably a B or maybe a B minus grade income statement here for PayPal, maybe even a B plus. But instead, we got a C. That just is what it is. So net income came in at $1.1 billion, and diluted EPS came in at 111 there. Now, the balance sheet. When you look at the balance sheet, total equity down slightly from this time last year, $20.4 billion in shareholder equity versus $21 billion, so down about we can call $600 million or so in equity. But it's the buybacks, man. That's where so much of the money's going. That's where so much of the cash is going right now. They're buying back shares aggressively on this company, which, as somebody that wants to be a shareholder for the next several years, I don't mind that. I'd rather than buy back massive amounts of shares. The shares are very cheap. If you look at a forward P basis on PayPal, it's trading very cheap. And so, the company should be buying back shares right now. It's the right thing to do for a growing company like PayPal. Now, if we look at, there's a few very important things here that happen in balance sheet and liquidity. If you look here, it says full year 2024 returned $6 billion to stockholders by repurchasing approximately 92 million shares of stock. But additionally, something big happened today. The company announced, board of directors is gonna do they're gonna authorize another $15 billion stock repurchase program, which is crazy. This new authorization is in addition to the company's June 2022 stock repurchase program, which had $4.86 billion remaining authorization. So, PayPal's going to be buying back a lot of shares. And so you're going to see the share count that PayPal has go down immensely over this next year. Not a small amount. We're talking. So basically, PayPal is going to set up for that earnings per share to skyrocket throughout this year and skyrocket even more in 2026. It's going to be a very exciting earnings per share story on this company. Now, if you look at their guidance, they guide it for GAAP EPS of 112 midpoint versus 83 cents in the same quarter last year. Non-GAAP, 116 midpoint versus 108 in the same quarter last year, right? And if you look at the fiscal year, GAAP, they're guiding for, we can call about 187, or excuse me, 487, right? That's versus 399 the same quarter last year. And non-GAAP, we can call it midpoint of around 504, right? 505, somewhere around 504, 503. And that's versus 465 in the same quarter last year. So EPS should be up substantially year over year. Keep in mind, they're probably sandbagging these numbers a little bit. Alex Chris knows the game of Wall Street. My opinion is they're probably going to come in and beat those numbers very easily. Don't be surprised if you see non-GAAP EPS of 515, 525, something like that this year, okay? Now, additionally, this is what Alex Chris, the CEO of the company, had to say. He said, PayPal had a strong finish and to a successful 2024 with results that were better than we expected. We set out at the beginning of 2024 to narrow our focus, improve execution, and reposition the business. 1 year later, I'm proud that we've laid a strong foundation for long-term, profitable growth across the company's most important areas. The improvements we made in branded checkout, peer-to-peer, and Venmo, plus the progress we made on our price-to-value strategy are beginning to show up in our results. The strong momentum we created sets us up well for 2025. Which is all about scaling adoption. I'm excited to share more at our Investor Day later this month. So looking forward to obviously that Investor Day. I think it is going to be February 25th, I want to say, but don't quote me on that. I think it's February 25th. So that's going to be very exciting. Alex Chris obviously sounds, and this is the main thing with PayPal. As I told you guys when I started making my investment in this company, it's very important everybody understands this. This was not a broken company. This was a broken stock, and the company needed a little work. What Alex Chris has done is he's tweaked this. He's doing his little work, right? Him and the team there. They're doing a little work here, a little work there. They're getting that done. They're fixing the stock, right? They're fixing the perception of the company, getting people to understand it better, getting investors to understand it better. They're doing these massive share buybacks now. Everything's headed in the right direction. It was a good opportunity for him, and I think he's making the most of it, right? And honestly, I know today the stock's down, and we'll talk about why the stock's down in just a moment, but at the end of the day, it's pretty clear to me PayPal's trajectory is up and to the right. And that's a great feeling here. Now, why is the stock down today, right? Why is it not up? They came in, beat numbers, the guide was good. Like, what happened? Wow. Wall Street. PayPal. They're talking about, we think the stock's pressure is more a result of high expectations rather than a structural issue around PayPal's transformation journey. So they're worried about the unbranded checkout side, the Braintree side of the business, because that only increased 2% year over year in Q4. It could be down next quarter, right? Last quarter it was up 11%. And so Alex Chris and the team is really focusing the unbranded checkout on profitability. And not just focusing on, let's run transactions to run transactions, right? So my personal opinion is this is short-term pain for the company. And keep in mind, if they didn't make these changes and they weren't focused on profitability, the company could easily be, doing much better revenue growth than what they're doing right now. And so Braintree's actually being a drag on the business right now. That's the thing everybody's got to understand. The unbranded, which is Braintree, that's a drag on the business model. PayPal and Venmo are the strengths in the business model. PayPal and Venmo. The weakness is Braintree. Short-term pain for long-term gain. At the end of the day, they're going to, be able to reset that Braintree business, I think, over the next couple quarters here. And I think get it to a much healthier place where we start talking about growth again, likely in the back half of 25, moving more into 26, right? And then that will start being a net positive to the business more. And then it's going to really be helping the bottom line as well. So, where am I at with PayPal? Buying more shares, selling shares, holding shares? Definitely holding. But honestly, I might buy some more shares, especially if this one has any weakness. I might start buying shares. I thought I was done buying PayPal, but I like where the company's headed. I like where that earnings per share is going to be headed. I like the buybacks that are going on here. And so, I wouldn't mind adding some more shares, honestly. We'll see. Alrighty. So moral of the story is definitely not a sell for me. It's either a hold or I might buy some more shares of PayPal. Hey, I want to thank you so much for watching that clip. I hope you really enjoyed it. What I'm showing you in front of your face right now is 1000xstocks.com. This is such an important website and service to use if you want to research companies, if you want to understand companies on a high level, so you can hopefully get better results in the market. And we know as the years tick on, money compounds. It is so important you research companies, you compare companies, you're listening to conference calls, looking at SEC filings. All that's included into 1000xstocks.com. So to enjoy 1000xstocks.com and to apply for that service, you can go to the description area of this video, or you can go to 1000xstocks.com, whichever you prefer. Okay, let's go ahead and jump into SoFi.
Squirrely today. I wonder what you make of the reaction.
Hey, thanks for having me, Carl. We had a record-breaking quarter in the fourth quarter of 24 and a record-breaking year. Record revenue up 25% year over year for the year in the quarter. Over 30% product growth and member growth. Also really strong margins and returns. So we continue to focus on durable growth, ensuring that we continue to drive strong returns. And we're doing that through brand building and innovation. The business is the best it's been, and I think the best is yet to come in 2025. We actually not only beat revenue and earnings in the quarter, but we raised 2025 revenue above consensus by about 10%. I think the thing that the market's reacting to is our EPS is slightly below where the street was. And that's primarily because we want to make sure we're investing in the business for the long term and not just driving profitability in the near term. So we're committed to 30% incremental EBITDA margins, which is where we were in 23. 24 was a conservative year in which we drove to GAAP profitability for the first full year. And now we're tilting back more towards investment so that we can grow the top line for this foreseeable future over 20%. We actually took our guidance of the CAGR from 23 to 26 and revenue up relative to before based on that incremental spending. So feel great about the business, a bunch of huge milestones in the year, and we're really happy with the outlook that we have.
We mentioned these originations. Do you think that points to a new chapter in the loan cycle?
There's definitely a more favorable backdrop for lending. We purposely took an approach in 2024 that was conservative.
So, by the way, I think this is very important, what he just went over there, right? Anthony Noto basically just said, the gist of it is we're going to focus on growth over profits right now. That's basically what he said. And so, how do I feel about that? I feel okay about that. And the reason I feel okay about that is, now, first off, I want to see SoFi continue to be a profitable company, right? I want SoFi to make a profit every single quarter. Every single quarter. Profits, profits, profits. With that being said, the long-term market opportunity for SoFi is so immense that Anthony Noto does still have to focus for the next, honestly, for this entire decade, all the way out to 2030. He's really still got to just focus on attracting more members and revenue growth. Members and revenue growth while staying profitable. We don't need to make all the profits right now. As a SoFi shareholder, I don't need us to be JP Morgan right now. I don't need us to be Bank of America or Wells Fargo. I don't need us to be making billions and billions and billions and billions of dollars of profits. No. I just want to see us steal massive market share. I want to be able to look at those member numbers quarter after quarter after quarter and be like, wow, we just grabbed another 500,000 members, another million members, another million members, right? That's what I want to be able to see. I want to see SoFi become a financial giant. That's why I'm investing in this company, because I believe they have the opportunity. Doesn't mean they absolutely do it, but they have the opportunity to become a financial giant, which means a market capitalization of 100 billion plus, several $100 billion. And if they could really do this on a high level, right? We're talking about a company that could be far more profitable than anything we've seen before because of their more asset-light model, fintech side, right? And then when we really think about the no branches, right? The cost profile of this company should be far lower since they're digital first versus traditional banks. They could emerge way more profitable and way better margins on their business than anything we've seen before in the banking space, right? So the moral of the story is in regards to SoFi, I want to see us be profitable every quarter. I do want to see those numbers grow, but the real focus should be on more and more members and customers right now. And honestly, that should be like that all the way until we get to 2030. And then we can, 2030 to 2040, then we can still attract more members and still grow market share. But that, I think, is really a time to just focus on profits, profits, profits.
and diversified the business. By the end of the year, our technology platform revenue and financial services revenue now accounts for 47% of our total revenue. So we're not a lender anymore. We're much more diversified. And we're also moving the revenue that we're generating to fee-based revenue. In the quarter, we had a record amount of fee-based revenue, up 63% year over year. That will be the growth driver going forward. It was 40% of revenue in the fourth quarter, and we expect it to be the significant majority in the future. So moving away from higher risk, capital intensive lending to fee-based revenue.
Anthony, Leslie Picker here. Good to see you. Within the tech segment, can you shed any light or share any color on what your pipeline looks like with regard to getting more big banks signing up?
Sure. Nice to see you, Leslie. On the tech platform revenue, the business is doing well. We would like to see it grow faster. 2026 will be a year of accelerating growth for revenue based on some deals that we announced today. We announced 3 deals. It's much more broad-based revenue stream, one of which is with the government for direct express benefits that will be integrated in 2026. And we also announced a large financial retail company that will be integrated in 2026. And when it is integrated, will be one of our top 10 revenue producers for the tech platform. And then we announced a deal with a national hotel chain to launch a white label debit card and checking and savings account. The pipeline of demand is very strong. The big financial institutions need to upgrade their technology. They're taking much longer to make those decisions than we anticipated, but we're still fielding many RFPs as well as performing proof of concepts as it relates to the financial institutions. But we don't have to wait around for them to make decisions, as there's other areas for us to drive growth, big consumer brands, B2B, as well as government services.
So Anthony noted it's interesting. He talks about financial institutions being very slow to make moves, right? Very slow to do this and do that, which could be definitely seen as a negative for the fintech side of SoFi, right? And for the Galileo side. However, that is exactly why SoFi is so well positioned to become a banking giant, right? Why they're so well positioned to be a financial giant? Because the more traditional companies are so slow in making decisions and so slow in moving to do anything, is exactly why SoFi has such an unbelievable opportunity over this next 10, 15, 20 years. And so it's kind of painful on one side, but it's kind of a blessing on the other side. Okay, so that's a way to kind of look at it from a competitive standpoint. All right, let's get in this interview around from Bloomberg with him.
Adjusted revenue up 24% for the fourth quarter, but you're pushing us forward in a forecast that isn't as high as the market wanted. Why?
Well, I think 2 things. One, 2024, we took a pretty conservative approach to the year in terms of our growth and our profitability. We really wanted to make sure that we were able to drive strong profitability in 24 to achieve GAAP profitability, to ensure we reinforced our balance sheet and a capital cushion, and we did just that. Prior to 2024, we had committed to a balanced approach to growth and profitability, where we would reinvest 70 cents of every incremental revenue dollar, and we call that 30% incremental EBITDA margins. So we took our revenue forecast for 25 up. We're in the best position we've been since I've been here at SoFi for the last 7 years. We're calling for 25% revenue growth, strong margins at 26%, just not an expansion in the margins, because we want to invest in the massive opportunity that still sits in front of us. And so we took revenue guidance up, and it's about 10% higher than the street, but that will require more investment, and it will help us ensure we have growth beyond 25. And we also took our revenue guidance for 2023 to 2026 on a compound annual growth rate basis higher as well. So the profitability of the business is there. We could drive more to the bottom line, but we think that's not the prudent thing to do, because we just see massive growth in front of us, and the ability for us to keep driving member growth and product growth of more than 30%, which we've done, and revenue growth of more than 25% is what we're calling for through 2026.
Anthony, the investment that you just described, what portion of it will you be putting toward artificial intelligence? It's the topic at the top of everybody's minds, and people are watching how companies are deploying it. Do you see, for instance, an agent-driven service perhaps at SoFi at some point?
The vast majority of our investment going into 2025 and 26 will be in building unaided brand awareness, becoming a trusted household brand name. We have great products. The reason why we're driving such strong product and member growth is because the products are very differentiated. And when we make people aware of them and they use the products, they not just use the first one and they gain trust with us, they use the second and third one. 30% of our product growth in the quarter of 34% was from our existing members. About 40% of our members take out a second product within 30 days. So we'll continue to invest in differentiating the product. Sofi Money is a great product. It has a high APY. You can do person-to-person payments. You could do Zelle, auto bill pay, 2-day early paycheck. And so we'll be investing in that. We'll be investing in our Invest product to expand the selection for Invest, in addition to other product categories like insurance and credit card and small and medium business lending.
You want to be able to offer crypto again. And that's something that the administration's talked a lot about. Look, on a day where we see such volatility that engulfs crypto too because of DeepSeek, is that really a product placement that you want to get into again?
If the regulations change so that cryptocurrency is permissible by bank holding companies, we would absolutely provide not just what we used to provide, which was the ability to safely and securely trade Bitcoin and other cryptocurrencies, but we'll also go into other areas like custodying and clearing, in addition to asset-backed lending, et cetera. But that will all be gated by the regulators, which we think should be coming over the next 24 months, and we'll be ready when it does.
Ultimately, are you feeling more risk on in this environment, the new administration, a way in which to develop your business, maybe M&A, because it doesn't feel like a risk on day to day?
We are definitely leaning into 2025. 2024 was a record-breaking year. We had record revenue, profits, returns, member growth, product growth. Couldn't be happier with the year that we had. The most proud I've been of the company since I've been here. But I think 2025 will be even better. We think the outlook is the best environment we've operated in over the last 7 years. Our business is bigger, stronger, and more well-known than it's ever been, and we have more resources to go after the opportunities. So we love our competitive positioning. We like the macro backdrop. It's a very different outlook than when we came into 2024, and we're definitely being more aggressive in innovation and driving durable growth and strong returns.
Anthony, back to the regulatory side of things. What is the one thing, one hurdle that you would like to see the new administration and Congress clear for you?
The biggest question is what will bank holding companies be allowed to do with cryptocurrency? What will be permissible? And that clarity is really critically important. The interest rate cycle, I think, has pretty good visibility and transparency to that. I think the economy also has really strong economic indicators. The big question is how much can we innovate? How much can we invest in these different asset classes that our members want to reinforce their ability to not just borrow better and save better and protect better, but to invest better? Investing is critical to reaching their long-term financial goals. We want to be there for every one of the major financial decisions our members make in their lives and all the days in between. The key is spending less than you make and investing the rest. So the more opportunities we can give our members to invest, the faster they'll get to their financial outcomes.
Yeah, and that will be an interesting kind of opportunity for SoFi over time is what are they able to do or not do in crypto, right? Because obviously that's a big asset class. It continues to get bigger, right? And obviously it has some incredible vicious down cycles, but it remains to be there. At the end of the day, it does get bigger, and so it seems like there's only upside for SoFi there, right? There's only upside.